this conference is only possible because of the strong partnership between the Federal Reserve System, the Conference of State Bank Supervisors, and the FDIC. And so I'm very pleased to introduce our next speaker. Marty Gruenberg was sworn in as chairman of the FDIC Board of Directors on January 25th, 2023. He has been a member of the FDIC board since 2005 and previously served as vice chairman from 2005 to 2011 and as chairman from November 2012 to 2018. The Federal Reserve and CSBS are pleased to partner with the FDIC each year on the Community Banking Research Conference, and we greatly appreciate Chairman Gruenberg's leadership and the support of the FDIC in organizing these proceedings. So please, everyone, join me in welcoming Chairman Gruenberg.
Well, thank you. Thank you very much for that kind introduction. And I wish I could be with you in person this afternoon, but nevertheless, I very much appreciate the chance to address this 12th annual Community Banking Research Conference today. This is a conference, as was indicated, that the FDIC is proud to co-sponsor alongside the Federal Reserve and the Conference of State Bank Supervisors. It has provided for over a decade now an important opportunity for in-depth conversations between academics, bankers, regulators, and other policymakers on the critical role of community banks in the U.S. financial system and economy. That's an issue near and dear to the heart of the FDIC. In our 2012 community banking study, the FDIC created a research definition for community banks with the purpose of identifying institutions that provide traditional banking services to their communities, specialize in relationship lending, rely on core deposits for funding, and whose offices are located in a relatively small geographic area. This is really a common sense working definition that I really do think reflects what community banks do. And by those criteria, community banks represent the most common business model in the banking industry of the United States, accounting for 90% of FDIC-insured institutions as of June of this year. As the primary federal regulator for the majority of community banks in the United States, the FDIC invests extensively in advancing our knowledge of these important institutions via outreach, supervision, and research. That stretches from our Community Bank Advisory Committee, which provides a forum for community bankers to meet regularly with FDIC board members and senior staff, to numerous reports and research studies that the FDIC sponsors, I should say a few of which have benefited from data gathered by the CSBS annual survey that I think you all heard about earlier today, to sponsoring conferences, including this event, in which we strive to improve and enhance our understanding of community banking and support its important role in our banking system. Now, one of the reasons community banks are regarded as the foundation of support for their local communities is their strong ties to small businesses. As you know, a core function of many community banks, small business lending is of tremendous economic importance. That's why today I am pleased to announce the release of the FDIC's 2024 Small Business Lending Survey Report, and to share with you a few insights that I think will help inform the discussion over the course of this conference as you all exchange views on the future of the community bank business model. Now, as you probably know, there's no universally accepted definition of a small business, but as of last year, there were more than 33 million firms in the United States with fewer than 500 employees. And according to the Small Business Administration, those firms represent 99.9% of all employer establishments in our country, more than 46% of private sector employment in the United States, and over 43% of our gross domestic product. While those numbers demonstrate how vital small businesses are to the U.S. economy, small businesses thrive in no small part because of their access to credit, for which banks in the United States are a primary source. Results from a 2022 Federal Reserve survey show that banks provide financial services to 87% of small firms and remain their most common source of credit among financial service providers. So banks are really critical to financing small business in the United States. In recognition of the important interplay between banks, small businesses, and the economy, the FDIC undertook a voluntary survey of banks with the aim to provide a more comprehensive view of small business lending by the banking industry. The FDIC Small Business Lending Survey was sent in 2022 to a nationally representative sample of 2,000 banks across the United States, both large and small. And that survey contained detailed questions on the way banks approve and underwrite loans, their markets and competition, the use of financial technology, and their lending to startup companies. About 1,300 banks responded to this request. That's an overall response rate of about 68%, which is pretty good for surveys of this kind. It is those responses that serve as the basis of the analysis for the report of findings of the survey. So with that as an introduction, I'd like to use the remainder of my time today to discuss three key takeaways from the survey report, covering the practices and experiences of the 94% of banks that engaged in small business lending in 2021, and I think are of particular relevance for community banks. And I think you'll see that as I review these findings with you. So the first finding from the 2024 survey report that I'd like to share is that advances in technology, as important as they've been, have not replaced the relationship-oriented and staff-intensive nature of small business lending in the United States. That was a threshold finding of the survey. From the smallest to the largest banks, small business lending is generally underwritten and approved by people, and the resulting loans are held on the books of the bank making the loan. Engaging in fully automated underwriting is rare outside of business credit cards, and the 3% of banks that do fully automate the underwriting of some loans typically confine its use to very small loans. So in that sense, small business lending by banks is one of the forms of lending that has remained the most consistent and traditional in how it's conducted. It's worth recalling that the survey was fielded in 2022 in the wake of the pandemic and the rapid adoption of remote communication in its aftermath. The 2024 survey report highlights that despite those changes and the general adoption of new technology, small business lending still takes place largely in person, either at a bank branch or during an on-site visit. Now, that doesn't mean that some things haven't changed, particularly in the way that banks communicate with borrowers. For example, the survey finds that a third of banks allow borrowers to complete at least some parts of a small business loan application online, or consulting about products, submitting an application, or signing closing documents. However, only 5% of banks, only 5%, let borrowers complete the loan process entirely online. That fact, along with that of the majority of banks requiring a branch or site visit to complete the loan process, lends further support to the notion that the local branch remains a key part of small business lending by banks. So to be clear, the 2024 survey report does show that banks are adopting new technologies, and this is important, but those technologies are not generally replacing the traditional practices of small business lending. More specifically, the survey asked banks how they were using or considering using financial technology when making small business loans, from sourcing applications to underwriting credit to tracking performance. In response, 31% of banks, both large and small, reported that using financial technology in at least one stage of their small business lending processes, with an additional 22% still considering its use. However, when banks use financial technology, they typically employ it for the steps that occur after the origination of the loan, such as for regulatory compliance, servicing loans, and portfolio analytics. As the 2024 survey report discusses in greater depth, a key strength of banks in small business lending is their focus on delivering top customer service and developing long-term relationships. The industry does not see financial technology as eroding that nature, but rather supplementing and supporting it. So that's a core finding from the survey. Now, the second takeaway from the survey report focuses on the key role of branches and staff in generating and maintaining relationships with small business customers. And I think you'll find all three of these key findings really connect with one another. Now, I've already spoken about the role the branch plays in completing the loan application process, which on its own points to the importance of branches for small business lending. I now would like to draw attention to the finding that the branch network is the dominant feature banks use when describing their market. In the survey, 80% of banks define their small business lending market as based on where their branches are located. For those banks, on average, their borrowers are typically found within 40 miles of their branches. Reinforcing previous findings, banks report the reason for not lending outside their geographic market to be largely related to forming those essential relationships with potential small business customers. 89% of banks say that potential customers outside their market prefer to borrow from a closer bank. Most banks also cite the challenge in developing relationships with customers beyond a certain distance from their branch, further highlighting the importance of maintaining a physical presence and having staff nearby. It's worth noting that establishing relationships as part of small business lending is virtually universal in the banking industry. The 2024 survey report documents that when interacting with their small business customers, nearly all banks emphasize high-touch, staff-intensive practices. Over 90% of banks say they participate in community events or ask staff to actively develop business relationships and share their expertise. 99% of banks say they rely on customer referrals in small business lending, with 93% deeming that a very important practice. And 97% make sure that a consistent group of staff are assigned to a given customer with 92% regarding that as a very important practice. These and similar findings in the 2024 survey report lead to the conclusion that the focus on staff interaction with small businesses remains a key strength of banks in the small business lending space and really are of a piece with the overall findings of this report. So now the third and final finding from the report that I'd like to share with you relates to community banks as relationship lenders that also echoes the theme of research papers featured elsewhere in this program. I just finished speaking about how all banks find it important to invest staff resources in developing and maintaining relationships with their small business customers. However, the 2024 survey report shows that small banks are more likely to take a comprehensive approach to underwriting and hence leverage the specialized knowledge obtained from their personal relationships to let them serve and provide credit to a wider set of small business borrowers. This is really a defining characteristic of relationship lending, particularly by smaller institutions. A hallmark of the community bank business model with respect to small business lending, in particular, is the ability to build relationships and capitalize on them in order to base credit decisions on a comprehensive look at the applicant that goes beyond credit scores and other standardized data. Specifically, community banks hold an advantage in gathering and using so-called soft information. That's defined as information that's difficult to quantify or transmit between individuals. Soft information such as a loan officer's assessment of an applicant based on their prior experience or judgment on the quality of the applicant's business plan is closely tied to relationship lending. In that regard, our survey asked banks how they use specific types of information for a given size of loan, shedding light on this whole subject matter. For larger loans of $1 million or more, small and large banks look at similar types of information when underwriting. However, for smaller loans below $250,000, small banks, this was a finding of our survey, small banks consistently evaluate more soft information than large banks. For a loan of $25,000, small banks are nearly twice as likely as large institutions to use the loan officer's assessment of an applicant as part of their underwriting process. And for a loan of $250,000, they are more than twice as likely to consider the applicant's business plan than larger banks. Our survey finds another important characteristic that distinguishes community banks from large banks. They are much more likely to have decision makers meet with small business applicants. About 90% of small banks typically have meetings between small business applicants and those who hold actual decision-making authority on loans, where the applicant can make their case in real time and the decision maker can actually evaluate them comprehensively and gather the kind of soft information, frankly, you just can't get from a spreadsheet. This practice is much less common at large banks. Well under half of large banks typically hold such meetings, and at the largest banks with over $50 billion in assets, it's under a quarter. Community banks are viewed as important competitors, not only other community banks, but also by the very largest national banks. Our 2024 survey report found that 63% of small banks say they have an advantage in lending flexibility over their competitors, something that only 23% of large banks claimed. They also hold an outsized share of commercial lending under $1 million. These findings help us understand why community banks appear to punch well above their weight in the small business lending space. The 2024 survey report shows that while nearly all banks prioritize relationships with their small business borrowers, not all banks are relationship lenders. Community banks are the ones that take the extra step to leverage those business relationships as part of the process of actually underwriting small business loans. Really a key point. And I want to take a moment to emphasize the important role that small business lending, as conducted by community banks, plays in improving their communities. The FDIC's 2024 Economic Inclusion Strategic Plan identified small business lending from banks as one of the most important opportunities for households to build wealth and to achieve longer-term financial security. The use of soft information by community banks in underwriting has direct implications for credit access. Credit-worthy small business borrowers who can't furnish the specific information that a large bank typically uses for underwriting loans may not be able to get traditional credit. Illustrating that point, our 2024 report indicates that while large banks tend to rely more heavily on the Small Business Administration and other government-guaranteed programs in order to make loans to startups, small banks are more likely to underwrite loans to startups using information gleaned in meetings and are less likely to need to seek a government guarantee. By accentuating these kinds of differences, the research presented during this conference, along with the findings in our report, I believe provide a valuable perspective on the role of community banks in the U.S. economy. The 2024 survey report finds suggestive evidence that in the 6 years between the 2016 and 2022 surveys, banks faced a sharp rise in competition for small business borrowers from credit unions and financial technology lenders. The ongoing consolidation within the banking industry, and especially between community banks themselves, further speaks to the pressures of being a small institution in the current environment. And further, the pandemic and the subsequent rise in interest rates truly tested the U.S. banking industry. Nevertheless, community banks have shown remarkable resilience during these recent challenging times. What the 2016 survey suggested, this 2022 survey affirms. The community banking model of small business lending remains highly competitive in today's financial market and is still vital for our communities. It is noteworthy that these critical ties to small businesses have survived the coronavirus pandemic, successfully navigated last year's banking industry turmoil, and continued to adapt to a changing competitive landscape. Our 2024 report helps us understand why. Being a community bank means embracing these comprehensive underwriting practices that truly set community banks apart. That is a strength of value that is worth preserving and supporting. A failure to do so would undermine what is clearly an essential pillar of the U.S. economy. So if I may, let me conclude by thanking Jim Fuchs of the St. Louis Fed and the entire conference organizing committee, including the outstanding administrative and technical teams that made this event possible once again. To the presenters, discussants, panelists, and conference participants, thank you very much for your involvement, your insights, and your commitment to furthering the exchange of ideas with productive discussions and stimulating conversations. For those of you in attendance at the conference, I believe you'll find copies of our 2024 survey report there for you, and I urge you to take it with you. And for everyone else, you can access our report from our website at fdic.gov. I encourage you to take a look at it for a more detailed account of small business lending by banks in the United States. Let me further offer a particular word of thanks to the survey team at the FDIC. They spent 6 years working on this project, which I really think provides an important line of sight into small business lending by banks in the United States, and particularly the role of community banks. Our team worked with banks and other experts to develop relevant questions for analyzing the results, which they used in writing the report. And needless to say, looking at the size of the team, it takes a village to produce a report of this magnitude. Finally, if I may, I'd like to thank our bankers, whose participation in our survey helped us deepen our understanding of the important institutions that they lead. Once again, thank you for your time this afternoon. I really appreciate the opportunity to share the findings of our survey report with you. Thank you all very much.
And thank you, Chairman Gruenberg, and also just to echo our thanks to the FDIC as well. As the chairman noted, we do have select hard copies just right outside the conference facility at the hospitality desk. And if you don't want to carry that around, it is available on fdic.gov. But I highly encourage you to spend a little time with the survey, and certainly appreciate the fact that it was released today during the 2024 conference.